Let's go.
Awesome. Thank you. Thank you for joining today, and thank you for the opportunity, Ashwin Vivek. So it's first time for me to do a webinar of sorts in a social settings outside of work. So it's going to be interesting, and I hope there is going to be a takeaway one or two for everyone who is either listening in later or listening in now. So I will get straight into it. This is a session on superannuation and a few actionable points that we can take away from these sessions. So we'll get into it. So first one is the agenda. I have few things that I will cover in here. That's a welcome. And next one is our 5 financial pillars. So when you say the 5 financial pillars, I am referring to different things that we would have to consider in being able to get to the finances sorted. So today's session would largely focus on the superannuation, and under the superannuation, we'll learn about what is it and why is it important. We'll have types of superannuation. There are different types of contribution types. Would have insurance types, and how we can get from knowing super to become a superstar. So that's something that we'll look to cover off later in the agenda. And also, there are some common mistakes that we can avoid, and what are those, and how we can avoid them. And finally, conclusion. So that's the agenda. And if you are finding anything else that it is missing out that you wanted to know, feel free to add a comment in the chat, and we will look to see how we can address that in the slides as part of the content or as a follow-up later. So introduction. So the goal that I had in being able to prepare for this pack was very simple, which is, uh, you know, we don't want to miss out on the opportunities that we have in our hands while we are at different ages. Like, some of us would probably be starting into the career, some of us are in the middle age, some of us would probably be in retiring stage. But superannuation is something that it is sticking along alongside, but one of those things that we don't necessarily actively look into it on a day-to-day basis. But still, there are certain things that we can do right now that can set us up for a long-term success. Um, and also, we can take advantage of tax savings. We can take advantage of salary sacrifice, and even doing simple things such as having the funds in the right um, growth fund or high growth fund or balanced fund, depending on the age and this risk tolerance that you would have, you can associate accordingly. So these are some of the things that we can adapt. So the idea of this entire pack or the entire content that it was prepared is that this will give you enough information for you to what act on and to know more about what it is available for you so you don't miss out on the opportunities. Uh, Me, the Sam or Somasundaram or Somu, I'm just an ordinary guy who's working in a desk job for the last 20 years. And, as I approach middle age, I suddenly developed a keen interest about personal finance, and I started consuming everything about personal finance, blog posts, talking to people, podcasts. So yeah, I've been soaked into it and learning and reading, and I've been enthused. And there are times that I've felt, um, a little bit cheated as well. Like, yes, cheated meaning the reason why I say use the word cheated is because when I started to learn about candle charts, patterns, and different support, resistance, and all of those things, I was like, "Oh wow, why I didn't get to learn any of these things in my college life, or why I didn't get to know about all of these things in my school life?" That it was more of a self-realization or a realization that it came to me to see, "Oh wow, yes, we are all grown or groomed to become sort of a corporate slaves, or that's sort of a thing that it was going on in my head." And then I was like, "Oh wow, this is what it is, and this is how it is, and this is what we are part of the game. We are part of the system that we are working on. So what can we do within our powers? We can't necessarily avoid any of these things from a corporate world or corporate things and whatnot. So what can we do from our powers?" So that's where I was more interested, eager, and this session is more interested in, like, sharing what I have been accumulating as a knowledge, sharing what I have been knowing as some of the information. So yeah, one of the things that I would say is that, like, if this information resonates with you, please feel free to act on it. But if it doesn't resonate with you, yeah, you can just ignore. And or if you have more questions that it interests you in knowing, oh, what does this mean, please by all means reach out. Um, while some of these informations that are shared are financial in nature, I wanted to mention that, like, I'm not a qualified financial advisor, and I'm nowhere close to being a financial advisor or any of those sorts. This is just me, who is curious individual who have learned certain things in finances, in superannuation, and I feel that, like, I have enough information that I've acquired over a period of time that I can share to benefit people who are either at different stages. They can learn more from what they already know, or they can take a 1 or 2 cents from this conversation and or add to this conversation that I might not already know as well. So don't treat this as a financial information or as a financial advice. Take this information as something that you wanted to consume, and if it resonates with you to make any necessary changes, do it. And that's a whole intent behind the session. Yeah, so we'll go on and then talk about the five financial pillars. So this is something that I I have been always thinking of, in being able to look to see associate everything to the first principles of what we are doing, why we are doing, and how we are doing. So this is one of my five first principles to look to see. Okay, what is money, and then, from that money, if money is a root, then where do we, or how do we associate that money into the different buckets or different categories? So then I came up with this idea of, like, okay, what, there are five financial pillars. What are those? Um, from a personal finance perspective, what are those? One of them is to establish a baseline or a net worth to understand where we are. And then second one is understanding the investment options and vehicles that we have. There are real estate investment, there are stocks, there is crypto, there is, like, heaps of investment options, mutual funds and whatnot. So that would be another understanding, learning about it would be another session by in itself. And that's where the portfolio starts to build, to say, okay, this is how I allocate my funds in different assets, different asset categories and whatnot. And the third one is protecting the most important asset, that is you, which is through insurance. So you can definitely look to see different types of insurance products that it is available for life, that's available for health and other things. So that is most important asset that it is protecting us. That's one of the things that needs to be considered. And today's session will talk about the retirement and superannuation, and also there is further we can consider is inheritance planning, which is, like, after us, what happens to the wealth or the money that we accumulated, and how we can essentially pass on these to our future generations. So these are essentially in which that I was thinking in terms of associating, and maybe in the future, if Vivek permits, or if there are things in avenues in which that this can be covered off in a later time, yes, I would, look to see and then share this information with the group in here.
We'll definitely look forward to that. I think today the focus is superannuation. We can definitely look at other
Perfect.
things in
Yeah,
future. Yeah.
yeah. So yeah, I was gonna. The reason why I bolded it is, like, to say today's session is gonna be retirement and superannuation. So I will get into it. First one, superannuation. Give a brief about saying what is a superannuation. So some of us might already know this is something that, it is a money that it is coming out in our payslip, that it is tucked away in some other place, or it is there. Probably some of us are actively looking in, every month, or more closely on a weekly basis or sorts, to see what the balance is. And some of us would probably be not checking in regularly. But anyway, at a high level, superannuation is designed specifically for retirement savings. Long before the history of the superannuation comes by, this was essentially made available for the wealthy people. And in 1992, the prime minister that was in Australia, he made that it is to be made available for all the people, and that is when superannuation really took mainstream. And this is specifically designed for retirement savings. it is an investment vehicle. I mean, like, it is an investment. It said like it is not an investment, but it is an investment vehicle or a structure that holds the investment, such as you can hold anything that you want to have, like stocks, bonds, cash, even property within a superannuation, just like what we would have outside of a super. It is not an investment, but it is an investment structure in which that you would be able to keep multiple things under that. So that's what super is, just like what we would have outside of super. The main advantage is that it gives tax advantage, and the disadvantage is as that, like, we can't access it until we retire, which is also a good thing. The reason is that, like, the compound interest can do its thing over a long period of time, that it helps to get the best outcome for the money that we have. And this fund is not accessible under until we retire, but also there is an exception in which that this fund can be accessed. That is when we meet the condition of release. There are very extreme situations in which this fund can be accessed. That I hope none of us need that level of a situation for that funds to be released. But in plain simple terms, this is an investment vehicle that can hold multiple types of assets, investment types of assets, and that it is available for us to take advantage of tax as well at a 15 percentage. If we go on to the importance, it's to secure our retirement, can get tax advantage, and it's compounding growth. And then, I will cover off the other things like super funds and contribution types as part of the next slides. One other thing that I wanted to highlight is the reference to this book, the Richest Man in Babylon. If you have not read that book, I would highly, highly, highly recommend picking up this book. And this is one of the books that I started off with when I started off the journey of reading about personal finance. The story that it goes on is very simple, which is like, irrespective of how amount that you earn, take 10 percentage and put it aside as a saving, and over a period of time this would essentially help to cover for you on a long run. So the same logic is here in superannuation. It was started off with 9.5 percentage, then it was 10, and now now it is at, right now it's at 11.5 percentage. The next year it's going to be at 12 percentage, which is good. There is a small amount of money that we are earning that it is getting tucked away on another side, which we don't have right now access to, but when we are retiring, then we would get as a income that we can use into different things. All right, I will move on to the next one, which is types of super funds. Largely, if we classify the types of super funds, that it will come into two broad classification: industry super and the retail super. So if we look at the difference, industry super, the ownership of the industry super is run by a board. It is run by a board representing employees and employees. A retail super is operated by a dedicated financial institution. The industry super doesn't operate for profit, but the retail super does operate for the profit. That's what the different. That's what the main difference is. The investment options is limited for super, but though it is still expanding, but in retail super, it does have a very broad range. Yeah, there are investment options across many different things. Fees are generally low for the industry super because it is for a non-profit structure, and retail super because of the options and expansion in which that they offer. And retail super does offer the financial advisor access to the financial advisor, how your fund is performing, etc. So they are tend to be expensive. Examples for industry super would be a super, Host Plus, etc. Retail super example would be a Colonial, First State, MLC. And investment returns, industry super averaging at a range of 7 to 9 percentage. Retail super is 6 to 8 percentage. That's just, I got that off of web, and it seems to be a reasonable number that I can associate with as well. So just for this exercise, I did went on a rabbit hole to figure out, in having a conversation with a retail super company, to say, here is my situation, here is my fund, here is where that I am at. If you look at considering myself converting from industry super to retail super, what I would have. So they did a lot of analysis. They did have a lot of conversation, and then the summary of that analysis that it came out is that, like, the retail super, they said that they will be able to get me much, 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 much far superior, better returns than what I can get in industry super. And when I dive deeper into to see where my fund is allocated and what the funds are doing or where that fund is allocated, it was all different high risk or volatile assets, which I was not keen on, and then I felt like, oh wow, this is not good. And then also their rate or the fees was far higher. I was paying around 0.9 percentage through my existing industry super, and their fees were more than 2 percentage. So I will show in another chart that is coming up later to see what that 1 percentage of fee would make in terms of super balance over a long period of time. So coming back to here to share an example of what is a better option for us or what is a better option for you under your circumstance. If you are someone who are, you know what, I have my life things that I'm more interested on. I don't want it to come in the middle of, I want to keep switching in, playing in, and all those things. I want to keep it straightforward, set and forget sort of a person. Then I would say look for a industry super. But if you wanted to have a wide range of investment choices, you wanted to have access to the financial advisor, you wanted to be taking control of the money more aggressively, more closely, then yeah, maybe a retail fund might be a suitable choice. But it depends on your personal circumstances and situations. I'm also providing a link to further reading. This information is from the Barefoot Investor, who is Scott Pape, a very famous, well-known financial guru who is a columnist in different books and different newspapers. So yeah, he narrates different options within industry funds, so retail super, and gives a view of like where it is best for us to allocate the funds and whatnot. So yeah, um, something for you to read later as a bedtime. Moving on, the next one is an important thing. Many of us are probably would have heard SMSF, or probably in the mode of like, oh, you know what, I can take advantage of SMSF. So I just thought I will jot down what SMSF is, and then I will also share my own personal um, history or situations with SMSF. So the advantage of SMSF is that like you can control over the investment. So the when you set up an SMSF, you would have an option to roll over the funds from your existing, wherever it is, industry super or wherever that it is, from there to a direct bank account. And from there, from the bank account, you can then distribute that funds to where you feel that it is best to allocate that one. It can go into purchasing a property and buy a real estate and whatnot, or you could, invest into heaps of different things. But only thing that you need to be aware of is that like the responsibility that it comes up with it, and it has a high auditing costs and other things. So which, as I said, like control over investment. There is a flexibility on where you want to put, and potentially cost efficiency is also there. If you have a very large balance, the cost of setting up SMSF and audit fees and other things can be looking at being minuscule because you have a large
Swami,
fund to support it. Yep.
question. In
Yep.
your experience, what is that large number?
Um, I I would say that like anything more than $300,000 is worth considering.
Okay. Yeah.
Yeah, yeah. I would come to my own
Because
situation, what I've done, and there
yeah,
is an example that I wanted to share as well, and
no
then
problem.
sure.
I just
So
wanted to, because large is a subjective number. I thought people should
very
have
true.
some number in their mind. Yeah.
Yep, yep, very true. Thanks for that question. So we have a benefit of estate planning. We have a benefit of tax advantage. We have an option to pool the family assets. Like me, I might probably have, let's say, 200 grand as in super, and if my wife has like 200 grand, there is an option to combine the 400 grand, and then take advantage of SMSF and whatnot. So the setting up, if you look at the disadvantage, it is time consuming. There is a high responsibility. If you have a low balance in SMSF, then it is a high cost. there is a complexity, there is also a regulatory and audit risk, and then there is no access to compensation schemes. Like, if you are through the industry super or through the existing retail super, if they go bust for whatever reason, then the government will still cover all of that. But if you are in SMSF, government is not gonna come in and then save you on any of the dollars that you have lost out of it. So, that it is something that needs to be considered. So my experience, now I will give you a story of my experience. So about a couple of years back, I did take into consideration that, like, oh, you know what, I have a quite a, decent superannuation balance, or like, I had enough balance that I thought, okay, maybe I would convert that into SMSF. Without realizing that I needed, like, up about 300 grand or whatever. I thought, okay, let me go into the world of SMSF. The reason why I wanted to venture into SMSF is that I was lured into taking advantage of leverage. I thought, if my superannuation in here is only $100,000, and if it is growing at 10 percentage, it's going to fetch me only $10,000 a year. So it's going to be $110,000. If I have $100,000 in my super and I set up SMSF and I purchase a property, and if property goes by 10 percentage, then $500,000, let's say property, and I put $100,000 as my super balance to buy it. And if it grows by 10 percentage, then I get $50,000. If it grows by 5 percentage, I still get $25,000, which is much, much, much more higher than what I would have got from $100,000. So I got lured into it, and I did open up an SMSF account, and I did pay for the setup cost, $3,000, and went into the journey of, like, finding options of how to do rollover and then all of those things. While I was doing all of these things, then somewhere along the line, I started to look back to see, for one, it is expensive, and two, I'm gonna be leveraging it off property where there is very, very few lenders who provide the options to lend money through super. The rate of interest that is being charged for SMSF lending is high compared to what the rate is for a individual purchase. Then I realized, wow, if I have to consider factor in all of these things, am I really making a wise choice? Another thing that I also, this was the last bit in the nail on the coffin for me to pull out, is because I was completely relying on Australian real estate investments to grow, 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 grow without having any diversification whatsoever, which I felt that it was, like, not a right choice. Because I do, I mean, like, I have a home that I live, which is already invested in. I mean, like, it's a property investment, and on there are IPs as well. So if I had to go and then concentrate everything into the real estate, then the ability to be able to diversify is gone. The insurance options was not great, which was high, and then the fees that it was coming out was high. So then I pulled out from setting up an SMSF. But it's just me. And again, like, if I have to say, should you also pull out or should you set up or not, the answer depends largely on your circumstances, the cost that you would have to pay in setting up, and then the value that you would get, and your investment objectives. If you are not someone who has a lot of investment property, or, I mean, like, you have one investment property, but you wanted to take advantage of leverage and whatnot. You are very good in real estate. You have very good connect with market. You know where to invest, how to grow the property value, and all those things. If you are one of those person, yeah, for sure, why not, like, take advantage of it myself. But for me, my thinking was, like, I wanted something that it is simple, set and forget, keep it simple, and just don't want to tinker around a lot. So that's just me as a personal experience that I thought I would share. I would pause here and then see if anyone has any questions on SMSF or the journey that I've been through so far, if I haven't been clear enough in anything.
Don't have a question, but I did put in the chat that my personal experience with SMSF has been very good.
Okay.
One strategy which you can use, which I am using, is don't leave the industry super fund. Get your insurance. Like I get my family insurance from the industry super fund.
Yep.
so that I don't have to take an expensive insurance from the SMSF. The other thing is, I'm the being in SMSF allows you to also participate in other growth assets,
Yep.
which a typical a very typical industry super fund won't have. And
Okay.
also the ongoing costs and setup, at least there are options. If you have a very simple one account sort of a setup, um, uh, the ongoing and setup cost for me actually is, yeah, less than 0.1%
Okay.
of the super. So yeah, my personal experience has been really good with SMSF. uh, yeah, just thought I'll share that with you.
Sure. That's a good perspective to have, Vivek. But like, I think, yeah, there you go. You would have different people who would have
Nothing
different
better than
opinions.
set and
Yeah.
forget. Yeah,
Yeah.
but
Yeah.
yeah,
So if you are active, if you know more, yeah, definitely, why not? Like, take advantage of it. Like, there are many situations where I've heard
correct,
people invest in SMSF or take advantage of buying the commercial properties, and then, like, they would have investment that it is reaping out with money, and then that it will essentially help to take care of their commercial properties. And, over a 10-year term, they would have their entire commercial property paid off through
yeah,
SMSF. That, from there on, happy days starts. Like, the rent is essentially going to be coming and then hitting you
correct,
in many shape and form. So if you have access to some of those information, if you are keen to be able to perform some of those things, yeah, take advantage.
correct.
Yeah, that's just
Yeah, just doing a
good.
time check. Somo, about 20 odd minutes left, so let's move on.
Cool. I will try and fasten up. So next one is contribution types and options. So there are many contribution options when it comes to accumulating the money into the super. There is, of course, employer contribution, which is at 11.5 percentage this year, and from 12 percentage starting from July 1st, 2025. So there is personal contribution and salary sacrifice. So employer contribution, the advantage is that, like, it has a consistent growth of the super balance with the money that we are earning from our employer that it gets over there. And then the limitation is that, like, only 11.5%. That's what government is mandating, and that's what it will get credited. Personal contribution, voluntary, made after tax dollars. So it's eligible for tax deduction up to $30,000 from this financial year. Up until last year, it was 27.5. From this year, you can contribute up to $30,000 into superannuation account, and our it is can be you can take advantage of 15 percentage. And the only disadvantage because of that is, it might impact our cash flow on a monthly basis. Salary sacrifice, the same thing, which is a pre-tax contribution made directly from our salary. What this means is that, like, it would probably reduce our taxable income, but it increases our super savings. So I would generally do, if there is an option where, you get a bonus from your job or whatever, right? You can direct some of that to go into your superannuation. That way, um, bonus money is a bonus money. You didn't have it, so when you get it, like, why not get it a little less? Rather, you look at putting it aside and then have a delayed gratification later. So just have a bit of it, go through that way. That it way helps to build your nest egg for a long time. Another disadvantage of salary sacrifice is that, it reduces your take home pay. There are different types of contribution types. Apart from this, there is government co-contribution, spouse contributions, and then there is contribution splitting, and even there is a downsizer contribution when you are closer to retirement, and you can take advantage of this downsizer contribution. But I am not going into detail of those things, but I have hyperlinked each of those things for people at different circumstances to read through, to understand, to learn from it. What are the other contribution types, and that it can take advantage of. Next one are insurance options. There are insurance that we can take within super and outside of super. So if you have premiums paid from the advantage of having insurance within the super is affordability and the convenience. You take it, and then the premium is get paid directly from super, which is very good. The money that it is inside the super is, we pay only 15% tax. So, why not take advantage for enjoying what that it is needed for today, which is insurance. Outside of super, you can take insurance, which is direct control over the premiums and funding options. And the convenience for insurance within Super is that, like, it comes with a default cover, and it makes it easy to set up. And outside of the Super, it is very tailored, very specific, and there are different options and situations that it is available for us to take advantage of. The disadvantage is, if we have to do this, it would of course reduce the super balance, because depending on what coverage that you have, the super balance would the money that we are paying towards insurance would essentially reduce in the balance that we would have for the super. And it does have a limited coverage, in here, and it probably needs a premium paid from after tax income would impact cash flow that we would have if we take insurance outside of super. And it also requires manual setup and can be a bit more expensive if we have to do the insurance outside of super.
So my question,
Yeah.
some industry funds give you a default insurance, right? Irrespective of whether you want it or not. Is that
Yep.
the case? Right? You will get a
uh,
default insurance from industry super
most
funds,
of
right?
Yes,
Most of them, yeah.
most
Yeah.
of the industry super funds provides a default insurance coverage, but, like, we can essentially look to see if that coverage is
Customize
enough.
it.
If not, yeah, we can customize it.
Yeah.
But it's also good to look to see what insurance option that we have. I mean, anyway, in one of the future slides, I will talk to see what option that we can do in being able
Yeah.
to look at
Yeah.
insurance. So the summary between our insurance option that it is within the super is, it's more affordable and easier to manage, but may reduce the retirement savings and have a limited coverage. If you are looking at outside super, it offers greater flexibility, comprehensive coverage such as income protection and all those things. You can take it to age 65 and whatnot. So it depends on what your personal situation is, and what your needs are and what's your financial goal in being able to take which insurance option choose works best for you. Next few slides. Okay, we have learned at a high level on theoretical information about super, um, the insurance options, fund types, and not not fund types and other things. So what I wanted to go from here as a segue, I said, like, we have learned about super. Now we wanted to become a superstar. What can we do to become a star? So I set it up in three phases: that it is start or setting up, and then accumulate and accelerate, and the review to retire, review and retire sort. So this is a three-step process that I thought I would come up with, just made up. We'll look to see what that information is in the next slide. So the step one is start or setup. For us to get started or for us to set up, there are things that we need, that it is like, yeah, you need Superfund login and ATO login and your SEPA statement. If you have these information now, then you can look to see what the rest of the things that you wanted to do in here. So I come from a data virus background and whatnot. So it was always like, we used to look to see what is current and what is future, what is current and what is future. So I went with the same approach in being able to look to see know where you are and know where you want to be. So that way you can establish the baseline for what it is. So if you are new and if you are looking at going to look to see what your super balance is and all those things, look to see where is your balance, and also check to see is it across multiple accounts, and where you want to be. Assess. I would say I highly recommend assess if it is worth consolidating it, because if you are having it across in multiple places and if you are paying fees across multiple places, then may or may not necessarily be worth paying fees at multiple places. So just see if that it is
This
worth
is
consolidating.
this is a major problem, Somo. I have encountered like people do multiple jobs. Every employer has got a
Yeah,
default super.
correct.
And yeah, I was in one situation where I had actually four super accounts, 4 or 5 years back from three or four jobs.
Yeah, there
Yeah.
you go. So yeah, it is something that I mean, like, again, 4 or 5 years back, I wasn't very trivial or very picky about looking into my finances as well. So I did have one in MSC one. I changed another job, then they had another account, and then never thought of merging or combining. And I was paying fees in both the places. I didn't even know what fees I was paying in and all those things, where my fund was and all those things. So it is worth considering to consolidate. That's number one that needed. And when you look at the current super balance, what is your balance, and it's worth looking to see how you're tracking to your age. It's not something that you need to be looking at alarmed off to say, oh my God, I'm so behind. Oh, I'm so ahead. Not that it is just more a benchmark sort as to see where you are and how much it is needed, how much it's needed. And if it is little behind, then there is some option that you can look to see consolidate into or do a contribution into the super funds. And that's something that I will cover up in the next slide as well to see what I'm saying as part of catch-up contribution. Also, it is worth looking at your current insurance options that you would have as what you would have in your account, and then look to see based on your age, circumstances, establish what you would need, and adequately cover yourself. Again, this should be available within your super funds. And the Barefoot Investor Scott Pep, he recommends, having anything like 10 times your annual income as your life insurance, depending on where you are. And if the rate is too much, yeah, look to see what you need to be reducing it. If it is enough, then yeah, keep it. That, but this number of 10x your annual income is just a basic general guideline. Another one is current fund allocation. There are multiple super funds gives different options, balanced, growth, high growth. I think by default everyone would be in balanced, which is not bad, but I think depends on your age. You might be well off in taking a bit more aggressive approach of being in high growth than being in balanced. Because the in balance, I think 60 percentage is towards equities, 40 percentage towards bonds, and standard growth. And again, this 60 and 40 is also depend on the industry super. Some would be aggressive about 80 percentage in balanced and 20 percentage in bonds, 80 percentage in equities, and 20 percentage in bonds. So this depends from fund provider to fund provider. But depending on age, if you have a long term mindset, I would say, highly recommend considering switching. Again, it depends on your personal situation. So that's what I mean. I've done changing it into all high growth because I feel I'm very optimistic about the future. So 20 years from now is when I would be able to access this money. So why not chuck it into get it at later? Current fees being paid. This is one important thing that you
Also,
would
you are
have.
young, so that helps.
Yes. I mean, I'm assuming everyone who's listening here or being in this call would probably be in the age of young. And even if we are not young, right? Even if at 20 years later, largely decide based on whether we need to switch from high growth to a moderate growth or, whatever that it is, base balanced one depends on how much money you would need for immediate few years. If you have enough money to live for the next 2, 3, 4 years, you don't have to be worried about the fund being in high growth. If high growth gives you a better return, then why not keep it there for a longer period of time? So next one, current fees being paid. If again, this is very important. So, um, future slide, I will definitely talk to you about what the fees, a small percentage of fees, how much that it would vary. So, look to see how much of a fees that you are paying. It should be there in your PDS or the statement that you would get every year. And if you are paying a lot in fees, I would highly recommend consider to see if there are other options in being able to reduce your fees. So there is also an option to look to see the how's your fund performing. Use the ATO My Super login. Then you can use your own log into ATO, then check to see how is your fund performing. Compare against the different funds that it is there. Compare against the fees that it is being paid across different, and assess to see if you are in the right fund. If it is not, look for a better option to consolidate. And especially if you are having across multiple accounts your super is sitting, then highly look to see where your money is and how much of your fees you are paying and where the better growth is, and assess if it is if your money is there in non-performing assets, and if you are paying high fees for it, it is high time that you have to switch it to a better one. So you can do that math by looking into your ATO My Super login. So yeah, I mean, we'll make this pack available for people to consume. So the links are available and are handy. So you can just log in and then look to see that. Um, so that's step one. So step two is accumulate and accelerate. So there is an option to carry forward unused caps, and that's the single best way to accumulate. So this is basically, for the last 5 years, if you have not contributed up to 27,500, maybe this from this year onwards, it's $30,000. If you have not contributed that much into your super, you have immediately, there are, 50, $60,000 that are sitting. You can just put it out there and you just pay 15% tax for that. But again, providing you have that much of a money or surplus in your hands, it is a better way to allocate the funds to take advantage of that 15 percentage. And also, if you don't, if this is, if you have multiple accounts, I would say consolidate to save money on the fees. And it's if you are employment provides, if you are a low earner, there is an advantage. You can take advantage of the government co-contribution. That's basically a free money that it can get into your super. So make use of it. And as I said, contribute extra. There's up to 30K into your super balance every year, depending on your circumstance. If your situation allows, pay up to 30K. That way you can pay less tax. But that means you don't get that money now to enjoy, but it is more of a delayed gratification to enjoy down the line. Catch-up contributions, the same as what I said above. Consider spouse contribution as well. And if you are really wanting to accelerate, as Vivek also mentioned, consider leveraging options into SMSF. If you have a low balance, or I wouldn't recommend straight off the bat. This is a little more complex, and perform a thorough research and do a cost versus value assessment before you venturing into it. So summary of this slide is carry forward contribution from your unused caps, invest up to 30K, and catch up contribution. Those are the things that you can do, and spouse and contribution. And finally, SMSF. So that's step two. Next one is step three about reviewing and retiring. So one of the things that I would highly recommend is make it a habit to track your super balance regularly. It can be monthly, quarterly, half yearly, annually, whatever works for you, but stick to it and do it. That's the single best thing or single most important thing that you can do. Probably it will not take a lot of time, probably, half an hour, but it is very essential. But your future self will thank you for what you're doing on this one, including some of us who are listening to this conversation. It's really appreciate that you're taking time out of yours to make time to listen to this, to take advantage or to save for yourself into the future. Another thing is review your fees, insurance, and investment options from time to time. You may or may not necessarily need 10 times your insurance or income protection. If that is not needed, just kill it. Look to see 5 times of your insurance is enough, then yeah, reduce it. If you don't need insurance at all, then why do you need it? You have paid off your principal, paid off your home, you have enough money, you can live even without having to work, then, why do you need insurance? Yeah, you don't need it, then yeah, kill it. So some of these questions are about retiring. So when it comes to retiring, there are a few things that we would consider, which is an asset test. The asset test is the single most important thing to know whether the government is going to pay you the money by the age pension, or it is something that you're going to live off of the money that you have made and accumulated into your superannuation. So this is an asset test that includes whether an individual is eligible for the government pension in this case. Yeah, so that's the asset test. So based on the asset that you would hold, that's what the government will decide whether that you are qualified or not. So how much of an asset that you can own and still get an age pension? So if you are a single home owner, you will get you can own assets of worth up to $695,000, and you can still get age pension. And if you are non-single homeowner, that means you don't have a home and your assets that you are holding is not exceeding 947,500, then yeah, you can get age pension. If you are a couple and you are a homeowner, then your assets that you are having outside of your principal place of residence should not exceed 1.045 million, or like roughly 1.05 million. And if you don't have a house, then your assets that you hold should be less than 1.3 million for you to be able to get government age pension. So PPR is considered under the asset test? No, PPR is considered and not, it's not considered under the asset test. So you can have a expansive $10 million house, and you can hold the asset less than 1.05 million, then you will still get the asset age pension. So how much can you get under the age pension? So if you are a single, per fortnight, you will get $1,145. If you are a couple, you will get $862 per person per fortnight. So anything I can do now to get age pension, I this is something that it is a little bit for catchy. But what I mean, what I have learned or what I've thought through is that you can set up your assets under a trust or a company, so you can still have access to it, but that it is right, but it is not under your name. So basically, what it means is that it is you are controlling that asset, but under a different name, which means you can still have access to the age pension if you are managing it that way. How much can I earn and still get an age pension? If you are working and if you are earning as a single less than $2,500 a fortnight, you can still get age pension. If you are a couple, you can earn up to less than $4,000 per fortnight, and you can still get access to age pension. And last one is, how much do I need for a comfortable retirement? So AFSA recommends or estimates, if you are a single, you need 52 grand per year for a comfortable retirement. And if you are a couple, you will need about 74 grand per annum for you to have a comfortable retirement. So this is just a ballpark number based on the um, information that I've gathered.
So I'm just
Um,
doing a time check. We are at
yep,
6. I'm happy to extend 10 minutes. I hope people on the call are able to.
just two more slides, and I think we
Yeah,
should be.
that's what I'm
Yeah,
saying. Let's
sure,
do 10 more minutes. Yeah.
sure, no worries.
Thanks.
Uh, Thanks, Vivek. So the next one is common mistakes and how to avoid. So the lost super, you know, there are many people who would have had super from different jobs, or there are many people, there are different places in which that they have the super. So, one of the things that I came across is that, like, how many dollars are in lost super? There are about close to less than $18 billion, over 7.1 million accounts in the lost super. So, people don't know, or some people joined from one job to another job. Their name was different in one job. It was something, there was a typo or whatever. So there is about $17.8 billion of lost super. So, you can look up and check to see if there is a fund of yours that it is existing in another place. It's worth having a look. Another mistake that you can avoid is, common mistake that I've seen is that, like, people doesn't review it regularly, and that it is bad. And recently I came across a video in Facebook that one person who's a localite who lives in the nearby area that I am in, he had his beneficiary set up as two other random people that he doesn't even know of. And if something had to happen for him, automatically the money that he has had would have gone to those people that he has no blood relationship, no relationship whatsoever, nothing. So it is highly, highly, highly encouraged to go and then check your beneficiary. And if it is not assigned to the right beneficiary of your superannuation fund, make necessary changes to it today. So, the hard earned money goes to the necessary person or people to whom that it needs to go to in the future. So, yeah, other common mistake is not understanding the importance of additional contribution. And sometimes we fall into the trap and the glamour of Facebook ads, and not understanding fully about SMSF and setting it up. I'm not saying SMSF is all bad, but, like, not understanding and setting it up is not good. And there are heaps and heaps of cases that I've heard about romance scams. People just fall prey for it, and especially when you're around that age, retirement age. Um, yeah, you get a lot of people reaching out to you saying this, saying that, and whatever. And sometimes people do get single because of their age and whatnot. So there are a lot of romance scams that happens with money that it is in the superannuation. So just be aware of it, be mindful about it, so you don't fall prey for it. Another thing that I mentioned about a few slides back is the percentage of money that it will be depending on the fees that we pay in the super account. So imagine if you are paying, if this is your super balance, if you are paying a fee of 0.5 percentage fees over a long period of time, the value would be at here, that it is like, more than 1.4 million, or that it is in years that it has been left to for 20 years. If you are paying 1 percentage fees, this difference in fees is resulting in like about 200 to $300,000. The same goes from that to this. If you are paying 1.5 percentage of fee, the value of the money over the 20 years period of time, it comes down to around 1.1 million. So imagine that if you are the fees of 0.5 percentage will put you into a retirement saving of more than 1.4 million. A fee of 1 percentage that you are paying towards super will put you in deficit of 200 odd grand. A fee of 1.5 percentage will leave you at a whole of $1.1 million, which is $400,000 of your money got eaten away by fees, which is such a big number. It is a stark number. So I would highly recommend looking at your fees that you pay and see if there are other ways in which you can reduce the fees. One of the lines that I came across in doing this research is Scott Pepp's line, which said, like, remember the person who you're talking to, your fees is their income. So this was by Scott Pepp. So, you know, just if many people are talking to you, or if there is a person from industry super, I mean, like, retail super is calling you and then asking you to convert your money or transfer your money or whatever, the fees that you pay is their income. I'm not saying don't do it, but assess the risk versus value that you get out of it and then make an informed decision. Conclusion, recap of the key points. So there is always a conundrum of, do I save for today or do I keep it for future, inside super versus outside super? You know, uh, Nothing is wrong, nothing is right. If you are putting in enough money within your super, and if you have fire in your mind, like, financial independence and retire early in your mind, yeah, you probably need to consider saving enough outside of the super as well. But if you are not thinking of any of those things, it's simple thing, keep it simple, keep it accumulated over a long period of time. Yeah, put it inside super, and that it will look after yourself when you are about to retire. That's going to be there. And based on the information that I shared, I encourage to take action to review your superannuation, and that will definitely help to set you for success in the long run. um, Reference and informations, I referenced a lot of materials that is available online, and I did use some of the large language models. Web resources, I used passive investing, barefoot investor, ATOs, MySuper, etc. That's a wrap. That's a conclusion. And, thank you once again for tuning in, listening in. And I hope you got a thing or two from listening into this conversation. And, thank you, Vivek, for giving me this opportunity to present in here today.
We definitely got a lot out of this session. But what I will do, Somo, is we'll open it up for 5 minutes for any
Sure.
Q&As. But generally, what I do is I stop recording for Q&As because people have personal questions. So just give me a minute. I will stop